Bitcoin is down almost 60% over the past 12 months, and skeptics who sneered at BTC's peak high of $69,000 are saying, I told you so, but our next guest says they are missing the point. Joining us now is Crypto is Macro Now economist Noel Atchison. Noel is also a former head of research at CoinDesk and Genesis Trading. Noel, great to have you as always. So you wrote a new opinion piece on CoinDesk titled A New Philosophy of Markets, Assets That Embody Technology. So while it's sexy to focus on price, you're saying we should focus on the technology angle, correct?
Absolutely, Christine. And hi, Lawrence. Also great to be with you both. Happy Friday 13th. This hit me over the holidays. I'm sure like many of your viewers, I was getting a flood of questions from friends and family I hadn't seen for a while about what I was doing now. Because obviously I had left crypto because obviously crypto is over, right? And so after patiently and repeatedly explaining that no, crypto was not over and that arguably it mattered more now than ever, I was wondering why is there this widespread misconception embedded in the mainstream public's mind? And then it dawned on me that crypto is associated with markets. The mainstream public thinks crypto is just a market because that's a lot of the coverage that they see. And these are generally people who do keep up with current events, but markets are what is generally associated with crypto in the coverage because markets are easy to understand, they're relatable, they move. Price going up and down is a lot easier to write about and read about than the potential of decentralized distribution, right? So understandable that crypto can become associated with just markets in the mainstream public's mind. Many of us have been for some time now explaining that now with the markets very quiet, it is time to focus on the technology, get that message out there a lot more. And if we're not actually heads down building, we should be supporting those that are. But then it hit me again that it's actually much more than that. Yes, crypto is a market of liquid assets that move around the world. And yes, crypto is a new type of technology, but not enough of us appreciate that it is both at the same time and integrally so. We're not talking about markets and technology doing their thing simultaneously. We're talking about them being the same thing. And I mean, take Bitcoin, for instance, Christine. Bitcoin is an asset, lowercase b, right? It moves on the Bitcoin blockchain, uppercase B, right? But neither have value without the other. We've never before had a concept like this, where you have liquid tradable assets that are themselves a technology. And this introduces a whole new philosophy into markets, and one that I hope regulators will spend some time thinking about because it just might change their framework.
Hi, Noel. Hola. And glad to see you again, of course. The use of Bitcoin or the use of Bitcoin as a proxy for the in the interest of or for the view of what the interest of Bitcoin, the network, will one day be, that's kind of been the idea behind the markets, right? It's almost like unlike, let's say, the internet, there was nowhere to buy the internet. You couldn't actually buy pieces of it. But with Bitcoin, you're essentially investing not just in the asset, but you're making a bet on the underlying rails and the underlying infrastructure, and that seems to have waned, obviously, from the 69,000 down to where we are now, 19,000. It's a big drop. Does this clearing out of large amounts of money, first of all, isn't there a negative effect? In other words, it discourages maybe some sort of outlier development going on in crypto, but also, if you're a young developer and you need to make ends meet, you're less likely to then go into crypto than you were before, only because you're looking at this and saying, well, gee, it dropped from 50 to 19. What if it goes down to 7 or 6? Maybe I should use my talents elsewhere. Doesn't this have an overall effect on the future buy-in to the network?
In my opinion, no, Lawrence, and I'm sure that if you asked any blockchain or developer right now, he or she would tell you that they're pretty happy with the salary that they're making. They are still very, very much in demand. There are not enough of them. When it comes to investors, that's why these discussions are so important now. It's not just a risk asset that, yes, with easy money went up to 69,000 and obviously has come down when that easy money was withdrawn, plus a lot of internal damage that has been done to the industry. It's much more than a risk asset, and this is the key. We know that crypto is often it's often equated to tech stocks, early stage tech stocks. And I've even talked about this narrative before, where here you have an opportunity to get involved in an early stage technology that is open to everyone, unlike in traditional markets where they are generally gated to those who are already wealthy up until a few years have passed, and then they do their IPO, and then everyone who has access to a brokerage account can get access. No, this is a way to have early access to technology, but it's even more different than that. It isn't just, as with most venture or early tech investing in the traditional world, a wrapper around a new use case of an existing technology in most cases. It actually is the technology itself. You drew a very good parallel there, Lawrence, when you mentioned the internet. It really is like being offered the opportunity to invest in the internet itself in 1985 with no corporation risk, with no artificial wrappers, with no potential dilution in the case of Bitcoin, et cetera, et cetera. This is a much more unique opportunity that I'm sure many people, even working in the industry, appreciate.
So, going forward, I mean, how do we get buy-in from it might not be institutional. I mean, and if I understand your worldview here, actually, it's not the worst thing in the world to not have these major institutions playing crypto right now. But how do we then get buy-in from, let's say, the retail, from the ground up, the way the internet did? Even though the internet was a government project, it was the small developers, it was the kids in the garages, so to speak, but it was also just the day-to-day usage of people sending emails and buying trinkets on eBay that really got things moving.
I will push back slightly on the classification of the institutions. We don't really need them right now. I think we do when we equate the institutions with what is traditionally known as the smart money, those that can afford to take the risks, those that understand the technology that they're looking at, those that know what they're doing, basically. I'm not saying that retail investors don't. Many do, and this has been one of the big frustrations with traditional market structure. Expert retail investors are denied the opportunity to grow their wealth, which is open to anyone with enough money. It just perpetuates the inequality inherent in the system today. So institutions are valuable for this ecosystem, not just for the legitimacy and the liquidity they provide and the sophisticated market infrastructure, but also for the money that comes in, let's face it. And I do think that what we're seeing now is signs of the institutions coming back in. We're seeing that through the size of the orders that are going through. We're seeing that through some other signs of behavior as well, such as on the CME. The institutions are probably, as is always the case, going to lead the rally when it comes. That's usually how it works. The retail investors, though, are also starting to pay attention, and those that care about the potential of decentralized distributed technologies are, unlike in traditional markets, going to have the opportunity to get in early and help it grow, as well as experiment and use case and test and participate and earn the rewards for their participation as well. That is a unique opportunity, again, that I haven't yet had the feeling the regulators fully understand.